This is Options for Strategic Investors, and this video is going to be about off-centered and unbalanced butterfly spreads. This video is for educational purposes only and not investment advice. The modern butterfly spread is described in the literature as a combination of a bull spread and a bear spread using 3 strikes and 4 options with defined risk and capped profit. Standard references and strategy write-ups explain construction and payoff, but there is not any attribution to a particular trader, firm, or decade. So the butterfly spread is a structure that has been around for a very long time. And the name butterfly comes from the payoff diagram, where we have a central peak with 2 declining wings as price moves away from the middle strike. So this is a screenshot of a long put butterfly in the OptionStrat software. This butterfly is symmetric with the center strikes at the money. And as you can see from the profit and loss diagram, it does look a little bit like a butterfly, hence the name. So the butterfly structure prioritizes time decay or theta and volatility risk premium or Vega over directional precision. And the core edge when trading butterfly spreads lies in its response to market fear. So as implied volatility spikes, the cost of entering into these butterfly spreads decreases, and that significantly improves the reward to risk profile for these trades. So there are 4 common classifications of butterflies. We have the classic symmetrical butterflies, which we just looked at in the OptionStrat software. We have broken wing, or what's called off-centered butterflies. We have unbalanced butterflies and calendar or time spread butterflies. And the differences lie in the number of contracts, strikes, and expirations for which these structures are built. Okay, so I want to move into the Tastytrade software here so we can build out some of these different variations to see what they look like. Right now, I have SPY populated in the trade tab, and we're looking at the March 20th, 2026 options expiration cycle. These options expire in 46 days, and what I have populated in the trade tab is an out-of-the-money symmetrical put butterfly spread, where I am long 10 of the 695 strike puts, short 20 of the 690 strike puts, and long 10 of the 685 strike puts to create this symmetrical butterfly. And this spread will do well if near expiration, the price of SPY drifts down towards these short 690 strike puts. Okay? So let's go ahead and take a look at what this structure looks like in the OptionStrat software. So I'm going to bring this up. And we can see here that at expiration, this structure will pay off a max profit of $4,760 in the unlikely event that SPY pins at $690 per share right at expiration. And this structure is a net debit of $220, well, prices are bouncing around, $230 to enter into the trade. And that's equal to our max loss. And this is considered a bearish trade because the current price of SPY, as represented by this dotted line, is currently trading higher. So SPY would have to drift down and be trading within this profit tent at expiration for this trade to make money. So not surprisingly, this is going to have a negative delta, and it's going to be negative 6.20. It's going to have a positive theta of 2.37, a negative gamma of negative 0.02, so very small gamma, and a negative Vega of 12.2. Now, what we're interested in isn't necessarily what this looks like at expiration, but what is this spread going to do prior to expiration? And what we're interested in here is the T+0 line, which is this solid line and represents the value of the structure given today's date, given different price, time, and implied volatility assumptions that we're going to make in the software. So as time passes, we want to take a look at what that T+0 line does. And you can see that that line lifts up and starts to fill in these dotted lines, which represent halfway in the trade and then at expiration, which is what we just looked at. And this means that this spread has an easier time of making money as time passes because it has that positive theta benefit. You can see here that as time passes, even if the price of SPY doesn't move and we're outside of this profit tent, this trade actually can make some money. And that's why traders like these butterfly spreads. So you don't have to be necessarily spot on correct with regards to price. You just have to be kind of within range as time passes for these spreads to make a little bit of money. Okay. And as time continues to pass, we can see that that T plus zero line changes and starts to fill in to represent at expiration. Now, these spreads do well when we can put them on when implied volatility is high, and that's because they have negative Vega, meaning this trade will be helped by a decrease in implied volatility and hurt a little bit by an increase in implied volatility. So if I slide the slider for implied volatility down, we can see that that has a very similar effect to this T plus zero line as the passage of time. Meaning it gets a little bit easier for the spread to make money as the price of SPY kind of trades around. Okay? Okay, so I want to move back into the Tastytrade software here and demonstrate what an unbalanced put butterfly might look like. We're still using SPY and we're in the same expiration cycle as the previous example, and we're going to use the same strikes. This time, though, we're going to build in a little bit of a bullish tilt into the structure, and we're going to do that by selling more put credit spreads than what we are purchasing in put debit spreads. And so what that structure might look like is it might look like a 10 by 30 by 20 unbalanced put butterfly. And if we populate that in the trade tab here, we can see that that structure would bring in a net credit of $1.09 roughly. And we're doing that 10 times. So it would bring in a credit on the overall trade of just over $1,000. And if we bring up the OptionStrat software and slide the slider all the way to the right, we can see what the profit and loss diagram for this structure looks like at expiration. So we don't have any risk to the upside. In fact, we lock in a max potential profit of the credit received if SPY trades to the upside at expiration. The max profit on the trade in the unlikely event that SPY pans at $690 per share at expiration is $6,090. And this structure is vulnerable to downside price movement at expiration beyond the break-even point of 686.95 with a max loss potential of $3,910 if unmanaged prior to expiration. So your max risk increases to the downside because you're selling more put credit spreads relative to the symmetrical put butterfly from the previous example. Okay, so let's see what this structure does prior to expiration. So let's go to today's date here. And we know that these butterfly structures are best to put on when you expect a decrease in implied volatility. So we like to put these structures on when implied volatility is high, or we think implied volatility is just going to go down from when we put the structure on. So let's see what that does to this T plus zero line. So I'm going to slide the implied volatility slider to the left to reduce the implied volatility that's priced in the options. And we can see that the T plus zero line lifts, making it easier for the trade to make money. And we know that implied volatility usually goes down as the price of SPY goes up. Oops. And so if that were to happen, we can see that this structure would make money pretty early on in the trade and become very profitable. And we know that this is a positive delta structure, and we're short more put credit spreads than what we are long in put debit spreads. So we would expect that a downward price move in SPY early in the trade would hurt the overall position. And when we slide the slider over, we can see that the T plus zero line is negative here, but the line is fairly flat. And what's interesting is if we increase implied volatility and we increase that assumption, because we know that implied volatility typically goes up as the price of SPY goes down, the T plus zero line actually flattens a little bit. And so it's not that the structure doesn't become negative as far as a P&L goes, but it's fairly resilient. It's not too bad. It's not till you get really far down in price for SPY that the losses start to show up early in the trade. So that's kind of interesting. And that's what an unbalanced put butterfly might look like early in the trade given these different price, time, and implied volatility assumptions. Okay? Okay, so we're back in the Tastytrade software here, and now I want to demonstrate creating an off-centered put butterfly or a broken wing put butterfly. They're both the same thing. And in this particular example, I want to give this a bullish tilt. So I have SPY popular in the trade tab again. We're in the same expiration cycle as the previous examples, and we're starting off with the same strikes as the previous examples. And I have repopulated the trade tab to represent a symmetric put butterfly to start. So we're long 10 of the 695s, short 20 of the 690s, and long 10 of the 685s. And if I wanted to put this on with a little bit of a bullish tilt, because I think SPY is going to trade higher and implied volatility is going to come down, I can accomplish that in two different ways. I can either slide the short strike puts higher to the 691 here, creating an asymmetric off-centered butterfly where the center strike is off-centered relative to the long wings. Okay, and we could get that done for a net credit in this example of 35 cents or $350 because we'd be doing a 10 lot. Conversely, if I wanted to just slide the long wing down a point or two or more, I could do that as well. So let's say that I want to slide the long wing down to the 680 strike. Okay, I could bring in a credit of roughly 88 cents if I wanted to do that and widen the put credit spread by 5 points. This structure would result in a net delta of positive 37. So there's many different ways that you can create these off-centered flies in order to create a little bit more of a bullish tilt on the position. So let's look in the OptionStrat software just to take a look at those two different structures just to compare them. So here we are, there's the original structure, and we can see here that we're in the symmetric out of the money put butterfly spread here that we started with. And to give this more of a bullish tilt, I'm just going to slide the center guts of the butterfly up one strike. And we can see how this would change the profit and loss diagram at expiration. We could put this on for a credit of $340. So we don't have any risk to the upside in this structure. And in fact, we would lock in that net credit if we held this to expiration and SPY traded higher. Conversely, put that back, we can slide the long put options further out of the money. And in the previous example, we slid it all the way to the 680 strike. And we can see here what that would do to the profit and loss diagram at expiration. So the shape of this would look very similar to sliding the center strike around. Okay, but your max loss is going to be a little bit different as you change the profile of the spread. Okay, so let's take a look at how these different trades would look prior to expiration as we analyze the T plus zero line. So let's go back to the original trade. And let's move the center strike up one notch. And implied volatility is at its original spot. And the T plus zero line is fairly flat, meaning this trade is fairly resilient early on to decreases in price. And let's see what happens if we increase implied volatility. So if we double implied volatility, we can see that the trade is very resilient to the downside. Conversely, if we reduce implied volatility, we can see the T plus zero line rise, especially as SPY trades higher. Okay, so that's not bad. Don't mind that. Let's see what happens as time moves forward. It's basically a very similar effect to a reduction in implied volatility. Okay, now let's play with the other variation. So let's move this center strike back to 690. And this time, let's take that lower wing and move it out more. And let's just move it out a strike so that we're comparing apples to apples. This structure would cost a net debit of $10. And so instead of moving the 690 strike up one, we're just moving the 685 strike down one. And what would an increase in implied volatility do? Boy, that line is very flat. And what would happen with time? So the T plus 0 line is very flat in that scenario. What if we move this further out? And let's go to the 680. So we're bringing in a much higher credit for moving it all the way down to the 680. And what happens if we increase implied volatility? What happens to that T plus 0 line? Boy, pretty resilient there. And let's reduce the implied volatility. Easier to make money to the upside, especially. And of course, with the passage of time, that's going to look very similar to reduction in implied volatility. So this is an off-centered butterfly structure, a broken wing butterfly with a bullish tilt. Okay? Okay, so now let's analyze these unbalanced and broken wing butterflies from a bearish perspective. So let's assume that you want to build out some hedges. And let's go ahead and break this structure once again. But instead of with a bullish tilt, let's add a bearish tilt. And so in this scenario, what we're going to do is we're going to slide this center strike, this 690 strike, down. And this is going to increase the cost of the trade to 80 cents roughly, or roughly $800. And let's take a look at what this structure looks like in OptionStrat. So let's bring up the original trade. That was the original trade, and we want to give this more of a bearish tilt. So we're going to slide this center strike down, widening the put debit spread portion of this butterfly. And we can see what that does to the profit and loss diagram at expiration. So it's just flipped by moving that center strike down. This will lock in a minimum profit of $1,200 on a significant down move where SPY is trading under 685 at expiration. Max profit potential in the unlikely event that SPY pins at $689 per share at expiration is over $5,000. And when we take a look at the Greeks, they start off as negative. It does have positive theta, positive gamma, and flat Vega. So let's see what the T plus 0 line would look like in this structure. And we can see here that a downward price move would definitely be helpful for this structure. And if that's coupled with an increase in implied volatility, we can see that that's actually going to hurt the structure. So something to be aware of. But that is what creating an off-centered butterfly with a bearish tilt would look like. Okay, so I want to move back into the Tastytrade software here, and for the sake of being complete, let's build out an unbalanced put butterfly with a bearish tilt. And we're still looking at SPY. We're in the same expiration cycle as the previous examples, using the same strikes. And this time we're just going to purchase more put debit spreads than the number of put credit spreads that we're selling within the structure. So I went ahead and decided that I was going to purchase 5 additional put debit spreads relative to the put credit spreads. So what this would look like would be buying 15 of the 695 strike puts, selling 25 of the 690s, and buying 10 of the 685s. I could get this done for roughly $2, which would mean that the net debit to enter into the trade would be just over $1,000. And let's take a look at what this structure looks like in OptionStrat. We can see here that if SPY were to sell off and trade under the 685 price point here, we lock in a gain to the downside of just shy of $1,500 on the structure. In the unlikely event that we pin at the 690 strike, max profit on this structure is just under $6,500 or kind of around there. Prices are bouncing around. And we do have risk to the upside. So if SPY moves up, we're going to lose the net debit that we paid to enter into the trade. And let's take a look at what this looks like prior to expiration. This structure benefits from downward price movement. And let's see what that T+0 line does with an increase in implied volatility. And we can see there that an increase in implied volatility flattens that line and makes it more difficult for this structure to make money to the downside earlier in the trade. And of course, as we move through time is friendly to the position. It becomes easier for that structure to make money with price movements to the downside and increases in implied volatility. So these bearish structures using puts in a butterfly are a little bit challenging because any kind of downward price movement that SPY might have is probably going to be accompanied by an increase in implied volatility, which makes it a little bit harder for these structures to be profitable in that scenario. So just something to keep in mind. Okay, so we just built out symmetrical, broken wing, and unbalanced butterflies using all puts. I want to note that you can do this using all calls, all puts, or a mix of calls and puts, and these are called iron flies. And if you want more information or refresher on this concept, please see the previous video in which we went into this concept in more detail. One thing that I want to note is I tend to favor building out structures using all calls or all puts, depending on which side skew is most prominent. So in equities, a lot of times we see put skew. In that scenario, I tend to favor building out these structures using all puts. In commodities, a lot of times you see call skew. And in that scenario, I favor building out these structures using all calls. So for the purposes of this discussion, we're going to focus on the equity side, and I want to make the case for building out these structures using all puts. So why do all put flies often trade better when we're talking about these butterfly structures? Well, in many widely traded equities and equity indices, downside puts are the most actively traded strikes. So this means that we have tighter bid-ask spreads and deeper liquidity around the body and the wings of the put fly. And in addition to that, put skew can make it easier to structure these flies where the short body is relatively overpriced versus the wings. And that's the whole point here of these structures, is to try to harvest this put skew. Additionally, I find them easier to manage when implied volatility regime changes mid-trade. So if implied volatility increases after I put on the structure, and a lot of times we'll see price pressure accompanied with that, these structures tend to hold up a little better, and managing them is a little bit easier on the put side. And that's regardless of the profit and loss diagrams that we see at expiration. So in all practicality, even though the call side and the put side look identical at expiration, managing how these trades behave prior to expiration makes all the difference in the world. And I find that the put flies tend to be easier to manage when we see an increase in implied volatility with a decrease in price. And then finally, I personally like to keep the call side of the options chain open. So because we see put skew a lot of times, I think calls are chronically underpriced, especially on the indices. So I like to keep those strikes open in case I want to build convex structures on that side. So if my core butterfly structures live on the put side, I avoid cluttering the call surface, leaving room for clean standalone upside structures that can take advantage of put skew and this chronic underpricing on the call side. So the separation allows me to manage the downside premium harvesting and the upside convexity distinctively, and I really like that. Okay, so I want to wrap this video up with a few key takeaways. All butterfly variations offer defined risk. And you can choose your structure based on your market bias or opinion. And with all these structures, time decay and volatility decreases work in your favor. So it's best to put them on when implied volatility is relatively high and you expect it to decrease going forward. Broken wing and unbalanced butterflies can be structured for net credits while maintaining one-sided defined risk. And the all-put butterfly should be considered when trading equity products with put skew in order to put on a structure that might capitalize on put skew. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, costs, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions can change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.